Hi everyone and welcome to FinLadder. In this video, we are going to talk about the Benjamin Graham formula, or also called the Benjamin Graham number. So this formula basically allows us to calculate the value of a stock trading in the market. So this is the formula for that. A very easy and basic formula. You just need to calculate the square root of 15 multiplied by 1.5 into the earnings per share multiplied by the book value per share. 15 into 1.5 is also referred to as 22.5 in many formulas, so it is the same thing. Now coming to what exactly is the meaning of each of the things mentioned in the formula. So it says 15. What is 15? 15 means the PE ratio of the company should not be greater than this. So if in case the PE ratio of a particular company is greater than that, then you cannot use this formula for that particular company. We have already talked about what a PE ratio is. So you can just refer to that video. Although the PE ratio, the book value, each and everything will be mentioned on many websites. You could go to Economic Times, Money Control, Bloomberg, Yahoo Finance, and all these websites you could easily find all the details. So this was the first part. 15 means that the P/E ratio of the company should not be greater than this, or simply this bracketed term. The next thing is 1.5. So what exactly does 1.5 means? So 1.5 means the price to book ratio should not be higher than this. So the maximum price to book ratio of a stock, if you want to use this formula, should be 1.5. It should not exceed 1.5. The last thing, what is EPS? EPS is the earnings per share, and we should be using EPS bracketed TTM. TTM means trailing 12 months. So earnings per share of the last 12 months. We need to use that. Again, it is very simply available and I'll be showing that to you very soon. Now let's just take a real life example, or rather two examples, to see how we actually utilize or use this formula on the stocks that are being traded in the market. So I'll quickly open the Excel sheet. I've taken two companies. One is ONGC and one is HUL, Hindustan Unilever. So just recall the assumptions once again. 15 used to represent that the PE ratio, as you could see here, the PE ratio should not exceed 15. So in the case of ONGC, it is 4.73 as on 1st May 2020. So this is very important, the dates. So on 1st May 2020, the PE ratio of ONGC was 4.73. So this ticks off one of the assumption that okay, we are ready to go with that. The next assumption was that the price to book ratio should not exceed 1.5. So the price to book ratio, as you could see, is 0.43 for ONGC. So again, we are good to go. Now let's just see or compare it with HUL. The PE ratio of HUL is 76.42, and just below that the PB ratio is 60.44, which simply means that we cannot use this formula for HUL, but for ONGC we are ready to go because it fulfills both the assumptions. So let's see how do we calculate it. Moving on to the next sheet. For ONGC, the EPS is 16.89, as we have already seen. Right on the bottom of the side, we could see 16.89, as well as the book value per share of 187.79. So we have mentioned both the details here, both the numbers. Same for HUL, the EPS is 28.72 and the book value per share is 36.31, as noted in the last two sections. So for ONGC, as mentioned, we are ready to go for the formula. We can easily use this formula. So let's see what value do we get when we use the Benjamin Graham number for ONGC as on 1st May 2020. So I have mentioned 15 and 1.5. They were the part of the formula. Again, just recall it. 15 represented the highest P ratio that the stock should have, and 1.5 represented the highest PB ratio that the stock should have. So quickly just calculate that. It was the square root of 15 multiplied by 1.5 multiplied by the earnings per share TTM, as mentioned. It was trailing 12 months. That means simply of the last 12 months. Moving forward, multiplied by the book value per share. So when we do this, we get the value as per this formula as 267.14. Whereas the CMP is the current market price as on 1st May 2020 is 80 rupees. I've just rounded this off. It was 79.9. But according to this formula, the value of the stock should be 267.1421. So I'll quickly mention one thing. See, this formula is amazing. It is used by many investors, but it is only a part of their fundamental analysis. There are a lot of things that this formula doesn't compare, doesn't include. There are many valuation methods ignored. There are many, you could say, financial statement analysis or be that ratio analysis, and a lot of things are being ignored. But it definitely helps you to analyze things better. But again, as I said, definitely not the foolproof method to invest in a share. It supports your analysis. So according to this formula or according to this number, ONGC should be priced at 267.1421, but it is priced at 80 at the moment. So according to this formula, the share is underpriced and should be bought. And if you do a thorough analysis and if you feel that that analysis is also showing a positive sign towards the stock, then it is a definite buy. Coming to HUL once, although we cannot use this formula for HUL as the PE ratio is above 15 and the price to book ratio is also above 1.5, but still just see why we cannot use it. The same thing, square root of 15 multiplied with 1.5 multiplied by the earnings per share and again multiplied by the book value per share. Quickly close the bracket and get the value. The current market price for HUL as on 1st May 2020 is 2195. It is nearly 2200 and this formula is showing it as 153.17. So you could see the major difference between the two. There is a massive difference between the two numbers that we have, the CMP and the value that we get from the formula. So it clearly shows that if the two assumptions of the PE ratio and the PB ratio are not followed, then this formula should not be used. Although as mentioned, it can easily be used for the companies or the stocks that have a PE ratio below 15 and a PB ratio below 1.5, as in the case of ONGC. So summing up, this formula is amazing to support your analysis. For a longer term, this stock formula is definitely a good to go. Thank you for watching this video.